Let's talk about why prices keep going up. Always going up, but almost never come down. If you search on the internet, ask ChatGPT or watch videos on YouTube, you'll hear the same explanations over and over again. People will tell you it's because of inflation. They'll say it's about supply and demand, fuel or energy costs, wars, raw materials, supply chain problems, or more money circulating in the economy. And yes, those explanations are everywhere. But in this video, I'm not going to talk about those things. Instead, I'm going to talk about something that nobody mentions, something that rarely gets explained when people discuss why prices keep rising. That's what this video is really about. So let's go deeper.
We're going to talk about why prices always go up, not why prices suddenly spike. Those are two completely different things. The main reason I wanted to make this video is to talk about production and inventory. When a company creates the first version of a product, the price is already set. Then the next year, when they release a new version or a new model, that new product almost always comes out at a higher price. And it's not necessarily because of oil, raw materials, or any of the usual reasons people talk about. The real reason is much simpler. Most factories don't sell directly to customers. Instead, they sell their products to resellers, stores, shops, and distributors. And here's the key point. Those products don't sell out immediately. So when the next year comes and the company releases a new model, the resellers still have inventory of the old models sitting on their shelves. Now imagine this situation. Let's say the first model was sold for $20. If the company releases the new model the next year at the same $20 price, customers will naturally choose the new model because it's newer and better. That means the stores and resellers will suddenly have a big problem. They will still be holding the old models that nobody wants anymore. And because they already paid for that inventory, they could end up losing money. So to avoid creating that situation, companies usually release the new model at a higher price. This allows the old models to continue selling at a lower price without completely destroying the reseller's inventory value.
And as you can see, as the years pass, products keep getting more expensive. That's simply how the system works. There's no way for prices to go down. So something you bought for $20 a day, if you try to buy the same type of product 10 years later, it'll certainly cost much more. A lot of it depends on how many new models are released over time. For example, if you bought a product for $20 this year, and in 5 years there is only one new version, maybe the price increases to $25 or $30. But if companies release many new models over the years, the price tends to climb even higher. And even if a company wanted to push the price back down, it's very difficult for them to do it. Because if they suddenly released a new model that was cheaper than the older models still sitting in stores, it would create a serious problem for inventory. Resellers and stores would be stuck with older products that cost them more than the new ones. So they avoid doing that. And that's the main reasons why, in this system, product prices tend to move in only one direction: upward.
Now you know why prices tend to keep going up and not going down. So now let's talk about inflation. There are many reasons inflation can start, but one of the biggest reasons is competition around basic resources. Think about raw materials, oil, energy, and other essential resources. Every company depends on them. They are the foundation of almost everything that gets produced. When companies start making more money by selling their products at higher prices, the companies that control those basic resources, like oil companies or raw material suppliers, also want to earn more. So they begin to raise their prices as well. But it's not only about profit. When the prices of products increase, the cost of living also increases. Employees now need more money just to buy the same things they used to buy before. Because of that, workers start asking for higher salaries. Companies then have to pay those higher salaries. And when companies pay more for resources, materials, and wages, they increase the prices of their products again. That's how inflation continues to grow. Let's take companies like Apple or Samsung as examples. Every year they release new models. Sometimes the improvements are small, but the new models often launch hundreds or 200 more expensive than the previous ones. Over time, 2 years, 3 years, 5 years, the overall price level keeps rising. As products become more expensive, employees need higher salaries to afford them. Companies increase wages. Suppliers raise their prices. Competitors do the same, and the cycle continues. So inflation doesn't happen simply because someone decides to raise prices. It happens because prices in the system keep pushing each other higher. There are many other causes too, like wars or supply problems. And those explanations are not wrong. But one of the main forces is this cycle. Higher prices, higher wages, higher supplier costs, even higher prices.
Another question you might ask yourself is this: do new models really deserve higher prices? And my answer is no, they usually don't. The reason is simple. Every year, companies already have teams of researchers and engineers whose job is to improve the product. That's what they are hired to do. Their work is to research, develop, and make the next version better. But those improvements don't necessarily justify a higher price. Most of the time, companies are still using the same basic materials and the same production systems. Sometimes they may introduce a new material or improve a component, but that doesn't always mean the product truly costs much more to make. In many cases, the product could still be sold at the same price as the previous model. After all, it's the same process, the same type of work, and the same goal every year: improve the product. Yes, sometimes a new model might include a little more material or slightly better components. But even then, that doesn't always justify the price increase. So if you're wondering whether the higher price is really because the product became much more expensive to produce, the answer is usually no. The higher price often exists mainly because the new model has to be priced above the previous models, not necessarily because it truly cost that much more to make.
Now let's talk about gold. Gold is a very interesting example because unlike phones, cars, or electronics, gold does not have new models. A bar of gold today is basically the same as a bar of gold 100 years ago. Yet the price of gold keeps going up over time. If you look at history, the price of gold has increased massively over the past decades. For example, after the late 1990s, the price of gold started rising strongly and has grown many times since then. But the reason is not because gold itself is changing. Gold is the same metal, it has the same properties. It doesn't suddenly become a new version like a phone or a computer. So why does the price go up? The reason is actually connected to everything we talked about before. When products in the economy become more expensive, phones, electronics, cars, food, energy, the amount of money circulating in the system also increases as economies grow and people accumulate wealth. Demand for assets like gold also increases. Gold is often used as a store of value, especially during economic uncertainty or financial crisis, which pushes its price upward over time. But if you think about it carefully, gold itself didn't become more advanced, more complex, or more expensive to produce in the same way new products do. What really changed is the price of everything around it. Phones become more expensive. Cars become more expensive. Electrodes become more expensive. Workers ask for higher salaries. Companies increase wages. So the obvious question becomes, if gold doesn't change, why does its price keep going up over time? The answer is not that gold suddenly becomes better. The answer is that the system around gold changes. When product prices rise everywhere in the economy, money itself slowly loses purchasing power. For example, if a phone used to cost $500 20 years ago and now costs $200, that means the same amount of money buys less technology than before. When people notice this happening, especially investors and large financial institutions, they start looking for assets that can protect their wealth. Gold has historically been one of those assets, so when product prices rise across the economy, large institutions start moving more money into gold. But here is the important part most people don't realize. The global gold price is not decided randomly. There is an actual process and institutions behind it.
These institutions submit large buy and sell orders for gold during the auction. The system then adjusts the price step by step. If there are more buy orders than sell orders at a certain price, the system increases the price. If there are more sell orders, the price moves downward. The auction continues until the market reaches a balance point. That final number becomes the global benchmark price for gold, which is then used by investors, banks, miners, governments, and gold dealers all over the world. But here's the key connection to what we talked about earlier in the video. These institutions do not operate in isolation. They are reacting to the entire economic environment. If product prices are rising everywhere, electronics, cars, housing, food, then the value of money relative to real assets changes. Large investors start allocating more money into assets like gold. Central banks may increase their gold reserves. Investment funds buy gold through financial products like ETFs. When these flows increase, the large institutions participating in the gold auction see more demand for gold in their trading activity. And when that demand appears in the auction system, the benchmark price gradually moves upward. So even though gold itself does not change, the financial system around it pushes its price higher over time. This is why gold prices often move upward over long periods. It's not because the metal itself becomes better. It's because the entire economic ladder of prices is moving upward, starting with products, wages, and costs across the economy. Gold simply reflects that shift. In other words, gold is like a mirror. When the prices of everything else climb higher and higher, the number used to measure gold also climbs. And because the benchmark price is determined by large financial institutions through structured auctions, that upward pressure eventually becomes the new official reference price for gold worldwide. So when you look at a gold price chart rising over decades, you are not just looking at the value of gold. You are actually seeing the reflection of an entire economic system where prices constantly move upward. And that system begins with something very simple. The way companies price their products and release new models year after year.
In conclusion, inflation is something that happens every year. Events such as wars, pandemics, supply shortages, and other global disruptions can increase and make prices go up faster. However, one of the deeper reasons why prices rise over time and never go back down is the constant release of new models of products. New models almost never sell for the same price as older ones. Businesses usually price new versions higher, so that the previous versions can still be sold without destroying the value of the inventory that companies and retailers already hold.